We're going to talk about the $1 trillion source. We're going to talk about the 4%. What 4%? Not the 4% that they tell you you should take for retirement. We're going to talk about the real 4%. How about the 4% that the wealthy know about? What do 4% of the wealthiest individuals do with their retirement money? That's what we're going to cover today in the Wealth Webinar Series. We're going to teach you the secrets of the wealthy as it applies to real estate, as it applies to your retirement. So let's get into this. All of us someday want to retire, right? Well, let me ask you this. What is retirement? Is it the day where we just stop working and we just sit on the couch or sit in our backyard, sail off into the sunset? What is retirement to you? A common answer I hear, and I'd love you guys to chime in, is retirement is the day when I get to pick how and when and what I do. That's a good answer, but we almost need to refine that more to what retirement really is, down to a finite science. And then we need to reverse engineer it and find out how you're going to get there and how you're not going to do it. If you listen to what we're going to teach you, is you are not going to give up control of your money. You are not going to follow the traditional, subscribed prescription to retirement, because you know what, folks, it ain't working. It's failing you. Most people plan to retire, and what do? They don't retire. They work into their 65 till they're 70, till they're 80. You know it, you see it. You've been to Walmart, you've been to the grocery store. Those people planned to retire or didn't plan. They wanted to retire and they didn't. The answer is they didn't know what you're about to learn. So
what we're going to do today is we're going to teach you what you're not taught in school, what you're not taught in college, what you're not taught by financial advisors, what they're never going to tell you, and why financial advisors are never going to tell you this stuff. I mean, Chris, you were an advisor for 16 years. I mean, when you learned about the money multiplier, you pretty much told Kessler, F off. There's no way that works. I knew everything there is to know, right? And
I like that. And Pam just said, I love this. This is her definition of retirement. Listen up, folks. I like to think of it as a legacy I live, not a legacy I leave. We cannot leave if we do not live. Think of the power of that statement. That is certainly a great definition of what retirement is. One thing we're going to teach you today is how you can do exactly what Pam said in a little different way, how you can actually get to your goal of retirement or whatever you said your retirement wishes are without giving up control of your money, without not having that money to use when you need it, to take advantage of opportunities. We're going to teach you how to dream bigger, be in more control, and do it with the real 4% rule, not the nonsense and bullshit that I learned as an advisor of called the 4% withdrawal rule, which is the 4% to failure rule, if you ask me. So Stephen, let's dive into it. Let's teach people, what do the 4% know? Out of all the retirement plans out there, and I'm specifically talking about IRAs, how many IRAs are there in the United States? You know the number, Stephen? I think I remember you saying that before.
So it's something like over 80 million IRAs, and then there's trillions of dollars within those IRAs.
So if there's 80 million IRAs in this country, that's a lot of IRAs, and there's trillions of dollars. Why is it that only 4% of all those 80 million IRAs are what we're going to talk about today? And what we're going to talk about today, folks, we've deemed it and called it the $1 trillion source, because that's exactly what it is. It is a source where trillions of dollars sit that all of you need to know about.
What we're talking about here are retirement accounts, and specifically what are called self-directed IRAs. Okay. So self-directed IRAs. So that's what we want to start with. Everything that we do with Money School revolves around the idea of taking back control of your money. So if you have control of your money, because let's face it, nobody else cares more about your money than you do. So if you have control of your money, you're able to then basically create the life that you want with that. Okay. And what I mean by that is, Chris talks about it all the time. Do you conform or do you create? Are you somebody that follows, or are you going to somebody that's going to take control and lead the way and take charge and be part of that 4 or 5%, right? And that's what this is all about. So self-directed IRAs are a way that it doesn't matter where you are right now, you can take advantage of self-directed IRAs. Number one, most people do not know about self-directed IRAs. Okay, so when it comes to self-directing or when it comes to retirement accounts, most people think of, 401k at work, or they have an IRA that they're, buying some options in or doing some day trading, or maybe buying some mutual funds and they're sitting in there and they're just growing and they kind of forget about it for retirement, right? So it's a way to save for retirement. Retirement accounts are also a incredible source though to tap into if you're looking for money. And that's where self-directed comes in. Is A, it allows you to control your money and grow it at rates very, very powerfully. But B, you can go out there and you can teach other people. So as we were mentioning a minute ago, less than 4% of all the over 80 million IRAs in this country and trillions of dollars are self-directed. And there's a lot of people right now that are starting to open their eyes to the fact that the stock market is going crazy. It's at all-time highs. Almost every single person I speak to, either on the phone or just people that I know in my personal life, they tell me that they think the stock market is going to drop, and they think it's going to drop pretty strong. A lot of people remember 2008. They remember the dot-com, and why they remember that is because a lot of people are now approaching retirement age. They're either in retirement or they're approaching that. And they know that if they don't do something and the market turns, half of their retirement is going to go away. It's just going to disappear just like that. So they're starting to explore alternatives. But stuff like self-directed investing is not taught traditionally. So that's why we, almost have a responsibility just to get out and talk about this stuff as much as possible. And if you're somebody that has a traditional retirement account, at like a Fidelity, a Morgan Stanley, or you have an old 401k, something like that, then pay close attention, because we're going to show you how to take that money from where it is now, move it into a self-directed account where you can now control it.
So the reason that 4% of all 80 million or so IRAs out there are not, the 80 million IRAs are not self-directed, only 4% of them are, is because most people get their financial knowledge from brokers, from bank brokers, from, their financial advisors, or some source. The traditional financial knowledge. Traditional financial knowledge is serving to the brokerage or the company that's offering the product, because that's how they get paid. A self-directed IRA, the only person who gets paid in any of the transactions are the self-directed IRA owner. You. The custodian charges a very small fee for holding the money, nothing like your regular IRA. And there's no mutual funds that are sold. Nothing will ever be sold to you by the custodian, because it is exactly as it sounds, self-directed. You direct the money where you feel it's suited best. Hey, maybe you want to direct it to stocks. Maybe you want to go to options. Maybe you want to buy gold. Maybe you want to buy crypto. Maybe you want to lend it out on real estate deals. Maybe you want to buy apartment buildings. It doesn't matter. Heck, maybe you want to buy a dairy cow, milk the cow, sell the milk out front, and then take the earnings and send it back to your IRA. This is what control is. You have the ability to control the outcome and the destiny of what your money does for you day in and day out. Traditional Roth IRAs or traditional IRAs, you have a small basket or maybe a large basket of investments to pick from. I remember selling, Fidelity accounts and Mainstay accounts and American accounts. And what we had to pick from were Fidelity funds, American funds, Vanguard funds. And if we got one of those fancy dancy expensive brokerage IRAs, we could buy any stock or any ETF or anything in that suite, but we couldn't buy a dairy cow. I couldn't lend money from my IRA to Stephen for his real estate deal and have him pay me 12%. Those were all things that just seemed too good to be true or just physically not possible. I simply didn't know the truth about what was out there. Only the 4% did. And now we're going to open you up to the 4%, because once you know this, you'll never look back at things the same.
Yeah. And, just looking at this real fast, two things that always jump out at me is, I'm a big fan of the show Shark Tank. Does anybody like that show Shark Tank on TV?
Heck yeah.
Mark Cuban and Mr. Wonderful and Lori and all of them. I always thought that was neat. And what a lot of people don't realize is you can actually use a self-directed retirement account to invest in startup businesses. And guess what happens if that startup business becomes a multi-million-dollar business? Your IRA just created a lot of profit within it, and it's all either tax deferred or tax free profit that's inside of there. So you get a self-directed Roth IRA, you invest in a startup and you make millions of dollars. You'll never pay tax on any of that millions of dollars. And if you want a great example of that, look up Mitt Romney. You have these IRAs with millions and millions of dollars within them. And people are like, well, how do you get that much money in an IRA like that? And that's how he was able to invest in some smart places. His money grew like crazy and it was all right there. So that's one really neat thing. The other one I really like, and I hear this a lot as well, you know, I like to trade stocks like day trading or swing trading, or I like to buy and sell options and kind of play in the markets, things like that. Well, with self-directing, you can not only invest in real estate, do private loans, become your own bank, invest in businesses and everything else. You can also still invest and play in the stock market. So with your self-directed, you connect it to a TD Ameritrade Thinkorswim account and you're able to follow all those strategies as well. So it literally doesn't limit you in any way whatsoever. And it really increases, all it does is increase your ability to what you're able to do. And the other one that I wanted to mention on this is Bitcoin. We could talk about Bitcoin for hours and hours and hours. And I've done it before with people, the pros, the cons, if it's a good idea, if it's not. What it almost always boils down to is the best strategy is to buy it, dollar cost average in, and forget about it. Just don't even look at it. Just throw away your phone alerts and all that stuff. And just, we'll check back in 10 years. Well, if you're going to buy Bitcoin at $30,000 and you think it's going to go to $1 million a coin, right? And you're going to do that over a long amount of time. Like, you're not worried about what happens day to day. You're doing this over time. Why would you not buy that Bitcoin within your retirement account, where if it does go to $1 million, you never will pay a dime of taxes on any of that growth? To me, that makes a whole heck of a lot of sense. So these are just some of the things that self-directed retirement investing allows you to do.
The other thing too, a lot of people try to make a self-directed IRA its own like little thing. It's kind of like, it's not its own little special thing. A self-directed IRA, whether it's a Roth IRA or a traditional IRA, whether it's a simple IRA or a SEP IRA, doesn't matter. It's exactly the same as what you have now, with one difference. The custodian for a self-directed IRA is set up to basically allow you to self-direct. A custodian like a Fidelity, a Vanguard, a Charles Schwab, a TD Ameritrade, any of those, they're set up to allow you to trade just allowable investments, stocks, bonds, mutual funds, ETFs. So you really, like Stephen just said, you can have, you know, your TD Ameritrade kind of open platform, which some of them actually call that self-directed, which it is not, because you cannot lend money to Stephen at 12% on his real estate deal in Schwab or TD or any of those. Where with an account like a Horizon Trust account, where my money is, that's a self-directed IRA. It's the same thing, same IRS code, nothing's different except for the custodian knows how to do what they do and allows you to it. Plus, there's no additional fees for all that other stuff. You just pay your annual fee for whatever your account balance is. And I promise you, it's less than what you're paying today in the self-directed world.
What we're doing today is we're teaching retirement based around what are called qualified funds, and then also using what are called non-qualified funds and how these can work together. So right now, IRAs, retirement accounts, SEPs, simples, here, I'll give you guys a whole list of them right now. These are all different types of retirement accounts: 401ks, solo Ks, SEPs, simples, traditional Roth IRAs. All these things are what are considered qualified funds, meaning the IRS has a special treatment for how these funds are handled, okay? And we'll get into that right now. So self-directed is not a legal term. It's just a descriptive term. And as Chris was saying, it's what that broker or what that custodian will allow you to invest your qualified funds into. The IRS, so legally speaking, an IRA at Fidelity and an IRA at Horizon Trust are exactly the exact same thing according to the IRS. So the IRS treats them exactly the same way. The only difference is what those brokerages or custodians allow you to invest in. When it comes to all these different types of accounts, keep in mind, when it comes to qualified funds, there's two different types of retirement accounts you can have. There's lots of different ways to save between the 401ks, the IRAs, the SEPs, the simples, the health savings accounts, etc. But there's two main different tax strategies to follow. So the first one is what's called a traditional. So it gets a little confusing. Like when we were talking about traditional IRAs at Fidelity, we just mean that as in like a legacy IRA, something that this is what the 96% of people have, right? So traditional, but so when it comes to the tax qualifications, there's traditional and there's Roth. And every one of those types of retirement accounts, IRAs, 401ks, SEPs, simples, etc., they can all be either traditional or Roth. Okay. So what the difference is in a traditional versus a Roth is basically how that money's treated. Do you want a tax savings on the money now, where the money grows tax deferred and you pay taxes on it later? Or do you want to pay the taxes on it now, where you don't get any special tax benefits right now, but the money's going to get in there, then grow tax free, and then you'll never pay taxes on the profits? So those are the two different types. The traditional means traditional IRAs, traditional 401ks, etc. Traditional means you are getting the money's going in before you pay taxes on it now. So where this could be beneficial is if you're able to take your taxable burden, your taxable income, if you're able to dump some money into a traditional retirement account, it could possibly lower your taxable income, and it could possibly drop you to a lower income tax bracket, where overall you're going to end up paying less in taxes. So that's one advantage. Also, it goes in there. And the other thought process with traditional retirement accounts is, right now you're in your earning years. So right now you have a job, you have all this earned income coming in. So you're at the highest tax bracket you'll ever be in life. So let's go ahead and take and put that money before the taxes are paid into this retirement account. Let's get it in there where it's growing tax deferred. So all the profit, you're going to pay taxes, but it's deferred until later on in life. And then as the money comes out of that retirement account, you're going to be paying taxes on it at that time. And the thought is that in retirement, you no longer have earned income. So when you no longer have earned income, if you just have interest or investment income, stuff like that, you'll be in a lower tax bracket. You won't have as high of a taxable income. Okay. So the thought is in retirement, when you start pulling money out, you'll be in a lower tax bracket. So you'll end up paying less in taxes then than if you were just to pay taxes on it now. Now is the Roth, which is you pay taxes on it now, so you don't have the tax benefit now, but once the money's in there, then it all grows completely tax-free. So all those profits, when you pull that money out, you'll never pay a dime of money on those profits. So Chris is setting up why it might be advantageous in this environment we're in these days to pay the taxes now, get it out of the way, and then not have to worry about it later on.
In some investments right now, if people had bought, let's just say Bitcoin or Ethereum or some of these highly appreciated cryptos, if they bought that in a Roth IRA, and let's just say they had a 200% gain, none of that gain is taxable inside the Roth. But what Stephen was talking about before Roth, we were talking about traditional. You took the bait and you decided to open a traditional because you didn't want to pay the taxes today on the money. It would, could be deemed as the lowest tax rate you'll ever be at. But now that crypto went up 200% inside your traditional IRA. Now you got to pay tax at a later time, probably at a higher tax rate on a crazy appreciated stock, where you could have avoided paying tax on all of that altogether by using the Roth.
And there are strategies too. One of the limits of a Roth IRA is there's income limits. So if you make a certain amount of money, you actually are no longer allowed to contribute to a Roth, for instance, right? But there's strategies we can follow to still get your money into a Roth. So example, we could take an old 401k or another IRA, and we can do what's called a Roth conversion, where we take that money and we convert it into a Roth. Yeah, you're going to pay some taxes now to do that. But again, you're getting it into this now tax-free growth environment where you can make these strong investments, grow your money very powerfully, and never pay taxes on any of it, and kind of get around some of those limitations. There's also solo Ks. So we can set up a solo K with you with what's called a Roth basket, so we can avoid those income limits as well. So there's different strategies. Also, you're limited with any IRAs. You're limited to like $6,500 a year going into them. But that's where the solo K comes in very powerful, because we can get almost $60,000 a year into one of those. So there's a lot of there's a lot of, noise out there around retirement accounts, but there's also a solution 99% of the time of things that we can do to avoid some of that stuff that people think stops them from investing this way. So let's just get into a couple little uses just to give you some examples. A lot of times, we can talk all about the details, but let me show you how it starts to come together. Okay. So this is just a real quick example of how you're taking money from where it is now and how to get it into a real estate deal. Just a real quick, simple example. So the money's right now at your current custodian or brokerage like Fidelity, or maybe it's an old 401k. You know, there's a bunch of those types of companies out there. So maybe it's sitting there, but it's sitting at a traditional type investment brokerage. So the first thing to do is initiate a transfer to a self-directed custodian. Okay. So what this is going to do by doing a direct transfer or a direct rollover, there's no tax consequences. So moving it from where it is now to somebody like Horizon, there's no tax consequences and there's no penalties whatsoever. It's just moving it from one custodian to another. All right. Once it's in there, now you have the ability to invest in whatever you want. So what you do is you get the deal ready, the contract, the agreement, everything that's involved with whatever that investment is, and you fill out what's called a direction to investment form. That then gets sent to the custodian. The custodian will initiate the wire transfer, and the money will then go to the company or the escrow of wherever that home is being purchased. So the money then goes there, and the house is now, and then the house ownership then gets transferred into your IRA. So your IRA now actually owns that rental property. Okay. And then what happens once the IRA owns that rental property is as the rents come in, those rents go right into your IRA. So your IRA starts growing. Down the road, you know, over time, let's say for 10 years, you have rents coming into this IRA. All that's doing is growing your IRA more and more. Again, if it's a Roth, that's all tax-free IRA growth within inside of there. And then let's say 10 years later, you say, hey, I no longer want to have this rental property. I'm done with it. I'm going to sell it. You sell that rental property, it goes from your IRA's name to wherever this, you know, whoever the buyer is, and whatever that purchase price was goes right back into the IRA. So if you had any appreciation in there, which over 10 years, real estate's always going to appreciate, you had some appreciate, that all goes back into the IRA. If it's a Roth, again, that's all tax-free. You'll never pay a dime of taxes on any of that. And then you can do that over and over. So that's a real quick just example of how you take the money from where it is now, buy real estate, and start taking advantage of that. I just want to do a real quick fire to give everyone a good idea of how all this works. So different options for self-directed investing in relation to real estate. So number one, as I just said, you can use the self-directed IRA to purchase the home directly, just straight up 100%. But let's say that you don't have enough within your IRA to purchase the home. Let's say you need to buy a rental house. It's $100,000. Okay. You have $50,000 in your IRA. So one thing you can do is you can take $50,000 from the IRA. You can take $50,000 from your infinite banking policy, and you can combine those funds together to purchase that home. Now, in that case, just be very careful. All repairs and all profits need to be proportional to whatever that purchase was. So if it was 50% and 50%, then 50% of anything else that happens and 50% of all profits need to go back exactly the same way back into those accounts. Okay, so just be careful on that, especially if you're new. Another option, you can leverage your IRA. Okay. So what that means is one of my favorite parts about real estate is leverage. And what leverage is means I can take $20,000 right now of my cash, and I can use that with a down payment and a loan to go purchase $100,000 worth of real estate. So that's leveraging my cash, right? You can also do that with your retirement account. So if I have $50,000 in my retirement account and I need to buy a home for $250,000, I can go to the bank and I can use my retirement account, $50,000 as collateral to get the loan for that $250,000 purchase. What that is it's called a non-recourse loan. One of the large advantages and benefits of retirement accounts, and really as well as infinite banking policies, money multiplier policies, they are inherently protected when it comes to asset protection. So they're protected, like your retirement account, if you like have a lawsuit, or if someone's coming after you, like a debtor or credit, like a creditor or something like that, they can't come after your retirement accounts, typically speaking. And that's true in life insurance too. So by getting the money in the retirement account, it protects it. So what happens is when you go to the bank, they're going to give you what's called a non-recourse loan. And what that means is if you were to default on that loan, the bank can basically only take that home and sell it off to recoup their money. They can't come after you personally because it was the retirement account that secured that loan. you are now protected personally, so that bank cannot come after you personally. So typically with non-recourse loans, you'll need, probably around 20% or more. It's not like some of these low down payment loans because they can't come after you. It's non-recourse, but you can do that so you can still leverage your retirement accounts, which to me is really, really cool that you're able to do that. All right. So options to purchasing as well. You can also loan funds to another investor. This is one of our favorite strategies just because if I go buy a rental house with my IRA, it can be kind of a pain because everything that happens, so any expenses, mowing the lawn, paying bills, it all has to come out of the retirement account in that case, right? If it's 100% retirement, everything has to be retirement. And if you do something that comes out of your personal funds, it can disqualify your whole retirement account. All right, so this is just one example of the growth of a Roth IRA. So if I took 45,000 cash versus 45,000 in a Roth, and I grew that money over the next 20 years at 17%, the total after 20 years in a cash account would be $426,000 because of taxes. The growth within that Roth account would be over $1 million. So we almost tripled our money. We over doubled our money at the end of the 20 years, simply by having it in a tax beneficial vehicle. So you know how I mentioned like you can take your IRA and you could take your cash and proportionally go in. Well, you can also do that with 2 IRAs. So if Chris had a self-directed IRA and I have a self-directed IRA and we wanted to partner on buying a real estate deal, we could do that. You just have to make sure that everything's proportionate again. So if it's 70% of my money and 30% of Chris's, all repairs, all profits, all expenses, everything need to be proportionally to that level. And just keep very, very good records. That's probably the best thing I can say when you're self-directed investing. Just keep very, very good records, especially if you start doing the proportional ownership stuff. How do I fund my self-directed account? Okay, so if you have an active 401k at work right now, unless you're over 50 years old or 55 or 60, depending on the company, and even then some companies don't allow it, odds are if it's an active 401k at a job you're actively contributing to right now, they're not going to let you touch that. Usually that's going to be held under hostage. Okay. I can't tell you how many people I talk to. They're like, yeah, I have these old 401ks, but I can't tell you even who to call to find out how much is in there or what it's doing. Like they have no idea. So they're pretty good at helping with that. So that's a great source. If you have an existing IRA somewhere, a Fidelity, Morgan Stanley, obviously you can do a direct transfer with that. And again, direct transfer, there's no tax consequences. There's no penalties. There's no problems. All right. You can also open up a new account. So that's when you run into some of these different contribution limits. So if you have no retirement accounts, and let me ask this, if you have an IRA now, can you open up another IRA? Can you have multiple IRAs? Yes or no? Yes, you can. You can have multiple IRAs. And there are strategies why that would make sense. So if you had an IRA somewhere, you don't want to transfer, you just want to start a new one, you can do that. Now you have to keep in mind though, these contribution limits, so 6,000 a year, this is actually up now. I think it's 6,500 now. But these limits that are on these accounts, it's not per IRA, it's per you. So if it's a $6,000 limit and you have 3 IRAs and you are evenly distributing, you can put 2,000 in each one of them. You can't put 6,000 in each new one. Okay. So let's just make that very, very clear. But you can open up a new account. So you can have multiple accounts and you can have them all over the place. And so that's basically the way it works. When it comes to retirement accounts, especially self-directed, the gold standard for these accounts is what's called a checkbook control solo K. A checkbook control solo K. I mentioned checkbook control briefly earlier. It's what allows you to literally control every dollar in and out of your retirement account without going through the custodian and having them conduct the transactions through the direction to invest form. You don't have to do any of that anymore. You're in complete control. Just make sure you're experienced or you understand self-directed investing before you do that. And then the solo K versus an IRA. A solo K just means you have an LLC and we can help you set up a new LLC if you don't already have one. So you can open up a solo K, but a solo K, as you can see on the screen, you can put, almost $60,000 or more into these if you're over 50, as opposed to an IRA, you're limited to 6,000. So you can put a lot more money into a solo K. The IRS seems to not really have as strict regulations on them. They're the same, but for some reason they seem to let a little bit more freedom go through them. They don't question buying real estate and stuff within solo Ks as opposed to an IRA as much. Maybe it's because they're typically larger, so they kind of think it's more common, but we've just seemed to find out over the years a solo K. So a checkbook control solo K is the ultimate in self-directed retirement accounts. So this is just one more example. It's one of my favorite. One of the things when it comes to retirement, especially, is stress. Like, retirement's supposed to be a comforting time, like a relaxing time, a time to enjoy life after you worked your ass off your whole life, right? I know it doesn't work that way, and but anyways, so one of the things that can help resolve that is not having to worry about money, where the money's going to come from. So if we can create a consistent, predictable income that you can use for the rest of your life, I mean, how many of you would like to live retirement not having to worry about money? So let me show you an example of what we were able to do with Charles and Mary Jones. So Charles and Mary Jones were one of the students that came to us just looking to grow their wealth. They knew that they didn't have what they needed. They knew what they were doing already was not working for them, and they did not want to be the definition of insanity. And what is that again? Doing the same thing over and over again, expecting different results. Nobody wants to be insane, right? So they came to us and said, we don't want to be insane. We want to do what the wealthy do. Please teach us. So we showed them how to go out there, create a predictable income for the rest of their lives consistently, and become their own bank. So they had 10 years from retirement, $350,000 in retirement accounts. They were inexperienced managing investments, and they did not want an active role. So they did not want to go out there and actively build a rental portfolio and deal with that. They didn't want to actively go out there and invest in multifamily or affordable housing or anything like that. They just wanted to passively put their money somewhere, let it grow, and do what they do in life, which was work and run their farm. Okay. So they came to us with that in mind. And here's what they did. So we taught them to become their own bank. And so they started with $350,000. They were also committed to each contributing $6,500 a year into their retirement accounts, contributions. So another $13,000 they were committed to contributing over those 10 years to their retirement accounts. 10 years. And what they did is they went out there and they created what are called trustees. Okay. So what they did is they went out and they created, they started doing private money lending. So what we did was we went out there and we taught them how to become private money lenders. And if any of you are in private money school or the private money club, or you've been through money school essentials, you know exactly what we're talking about. What private money loans do is you're lending your money on real estate deals. By doing so, your money is protected by a hard asset, by whatever that real estate is. Okay. You are now, by doing private money lending, you are in what's called the first lien position. So the first lien position, meaning if anything goes wrong, you can foreclose and take control of that property so you can go and sell it and recoup your money, okay? First lien position is what you want to be in. You also want to make sure that there's insurance on the property, that the lien is filed and all that good stuff. But essentially speaking, you now have a first lien position on this property. To do so, you need to create a contract or a mortgage, okay? So a contract or a mortgage on this loan or a promissory note. Within that contract or that promissory note, that mortgage, there's 4 essential things that need to be in that contract. So number one, what is the loan amount? Okay. So how much are you lending? Number two, what is the terms of that loan? So when is that money going to be paid back? Is it going to be paid back interest only? Is it going to be paid back in 12 months from now, in 18 months from now, in 30 years from now? Is it amortized? Like, how is that money going to be paid back? Number three, what's the cost of that money? So what are you going to charge interest wise? Are you going to charge points? And what points are is if I'm lending $100,000 and there's 2 points, it's 2% just upfront on the total loan amount. So in that case, $2,000, 2 points on 100 grand is 2,000. So that's just in addition to whatever the interest is being charged on that loan. Very common on private money loans, 7 to 12% interest, sometimes points depending on the experiences of the borrower and things of that nature. We won't get into that right now. So that's the third thing. What's the cost of the money in the contract? And then the fourth thing, as I mentioned before, what's the collateral? So what is backing that contract? In this case, the home of the house that's being flipped. So what we did is we taught Charles and Mary to go out there and create these promissory notes, become the bank, create these mortgages. So by doing that, they decided that they were going to lend to people that they knew, that were experienced investors, that they could just give their money to, let them do their thing, and that borrower would pay them 9% interest on a regular basis. So they went out and they started following this concept. Over 10 years, they were able to grow their $350,000 principal investment to just over $1 million. Okay. So now this is 10 years later. They have just over a little over $1 million in their retirement account. We following so far? I'm going to show you the next step here. Okay. So then they got to retirement and they said, okay, we now have $1 million sitting in our account that we can start using. However, they said over the last 10 years, we've been doing these private money loans at 9%. It's so easy. It's like second nature now. It's like once every few months, we sign the paperwork for a new loan, we get it back, and then we do that again once every few months. It's no problem. So in retirement, we want to continue doing that. So what they did is they said, okay, we're going to continue doing private money loans. So they took their $1 million that they had built up in their retirement account, and they continued to lend that $1 million out at 9%. By doing so, it created a $92,000 annual income for themselves, or around $7,700 a month. They now having coming in predictably, consistently for the rest of their lives, as long as they're willing to spend a couple hours every few months to continue doing these loans. And keep in mind, by doing these loans and growing their $1 million at 9%, that and creating a $92,000 income for themselves, they never touch their principal investment. So that $1 million nest egg that they have built up in that retirement account never gets touched. So if they ever want to go out and splurge and buy something big, or they ever want to just quit doing money lending, or they ever want to just whatever they want to do, they want to leave that to their kids later on. That's money that's now creating a legacy for later on down the road. They've created almost $100,000 income for themselves annually, and they do little to no work consistently. Does everybody like that strategy right there? Would everybody like to know they have another $7,700 a month coming in every single month, basically guaranteed for the rest of your lives? You guys like that idea? And this is all about taking back control of your money and self-directed investing. And wait until we show you how you couple this with things like HELOCs, how you couple this with things like infinite banking, like Devin has been able to do, to not only create this income stream through private money lending and real estate investing, but also a whole nother income stream through the infinite banking concept and all the different avenues of income that that creates.
So folks, thank you for joining us for another episode of the Wealth Webinar Series. We will see you either at the Ask Me Anything or next week for what will be an amazing Wealth Webinar Series all about privatized banking and the infinite banking concept. Until then, we'll see you next week.